Hi there, I'm Edward Kalstian, founder of EKH Capital, and welcome back to the channel. Today we're diving into Ulta Beauty, one of the largest and most unique beauty retailers in the United States. Ulta brings prestige and drugstore cosmetics, skincare, hair care and even salon services all under one roof. With a powerhouse loyalty program and growing digital presence, Ulta is redefining beauty retail in a rapidly evolving market. We're going to break down Ulta's stock using the 5 key factors to determine whether it's undervalued, fair valued or overvalued. We look for high returns on capital, strong growth, healthy financials, an undervaluation and a sustainable moat. Before we jump in, if you find value in this content, please like this video and subscribe to my channel so you never miss out on any future deep dives. First up, we want companies that know how to deploy capital efficiently, ideally with a return on invested capital and return on equity ratio that is above 15%. Ulta delivers here in a big way, with a return on invested capital at 28.3% and return on equity at 50.4%. Over the past decade, both metrics have trended upward, aside from the dip in 2020 during COVID. What's worth noting is a subtle decline in the last 3 years, due to total capital and equity growing faster than profits, as net income growth has softened in recent years. Still, these are elite-level returns that speak to Ulta's operational efficiency. Ulta has been a growth machine. Over the past 5 years, revenue grew at a compounded annual growth rate of 16.4%. Net income grew at a compounded annual growth rate of 61.6%. And earnings per share exploded with a 68.9% CAGR, ending fiscal year 2024 with $25.3 in earnings per share. However, 2024 was a slower year as operational complexity caught up, particularly around new fulfillment options like buy online, pick up in store, same-day delivery, and ship from store. Still, new CEO Keisha Steelman brings a strong track record and is calling 2025 a transition year, with expected revenue between $11.5 to $11.6 billion and earnings per share between $22.5 and $22.9. What's exciting? Ulta is refocusing on wellness, building a new marketplace, and preparing for international expansion in Mexico and the Middle East. Let's talk about Ulta's financials. Ulta holds $700 million in cash versus $1.9 billion in total debt, so they can't fully cover liabilities with cash on hand. But we care more about leverage, and Ulta shines here. Their debt-to-equity ratio has dropped from 1.2 in 2021 to just 0.8 in 2024. This tells us the company has kept debt under control and has room to invest in future growth without taking on unnecessary financial risk. What about Ulta's valuation? Ulta is currently trading at a price-to-earnings ratio of 14, far below the S&P 500's PE ratio of 27. Despite the recent earnings softness, Ulta's 68.9% earnings per share growth over the past 5 years blows the broader market out of the water. And according to super investor Peter Lynch, when a company's earnings growth exceeds its price-to-earnings ratio, it often points to undervaluation. Ulta fits that profile perfectly, making it look like a potential bargain for long-term investors. Ulta's business model is hard to copy. They're the only major player combining prestige and drugstore beauty products plus salon services. Their Ultimate Rewards program has over 40 million members, driving repeat purchases and boosting retention. They've also locked in exclusive partnerships and strong vendor relationships, giving them early access to trending products and maintaining their brand authority. But it's not all smooth sailing. The beauty industry is highly competitive. E-commerce giants like Amazon, direct-to-consumer brands, and Sephora, backed by LVMH and expanding through Kohl's, all pose threats. Ulta's physical store footprint could become a weakness if consumers continue shifting online. Continuous innovation will be key to defending their edge. Now, before we conclude on Ulta, you may have spotted in the charts shown in my video that these were created with the help of FinChat. If you want to take your investment analysis to the next level, then click on the link in the description box below to receive a 15% discount for FinChat and unlock powerful tools to make smarter investment decisions. In my view, Ulta Beauty stock is undervalued based on the 5 key factors. Ulta still delivers solid returns on capital with a 28.3% return on invested capital and 50.3% return on equity, showing strong financial efficiency despite recent softness. Earnings per share grew nearly 69% annually over the last 5 years. And while 2024 was slower, 2025 is set up as a transition year with new leadership and fresh initiatives. Debt is well managed with a low debt to equity ratio of 0.8, giving Ulta the flexibility to invest and expand. With a price to earnings ratio of 14 and growth far outpacing that, this stock looks undervalued by classic metrics. A unique retail model and loyalty program give Ulta a strong edge. But Ulta needs to keep evolving to stay ahead of competition like Amazon and Sephora. So what do you think? Is Ulta a hidden gem or are the risks too high right now? Drop your thoughts in the comments. And if there's a stock you'd like me to cover next, let me know. Thanks for watching and I'll see you in the next one.